Hello everyone, and welcome to the Financial Horse Guide to the 7 things to look out for when investing in REITs. The first one is a strong sponsor. As the legendary quote by Warren Buffett goes, rule number 1, never lose money. Rule number 2, don't forget rule number 1. And because of this, you should never make investments in REITs that could potentially go insolvent. So for this reason, I only invest in REITs that are backed by a strong sponsor. And for me personally, this includes CapitaLand, Mapletree, Frasers, Ascenders, and Far East Organisation. Because the key question here is whether the sponsor will abuse the REIT or will it value add to the REIT. And with a strong sponsor from one of those I just listed, you enjoy a number of benefits such as corporate governance, a strong pipeline, and a big size. The next point is the price over the NAV or the book value of the REIT. The key question here is whether the current price is attractive when compared to the underlying value of the real estate. So when you buy a REIT, always check the price over its NAV value. Compare the price and NAV of the REIT you are purchasing against comparable REITs in the same industry. The goal here is to pick up blue chip REITs aggressively when they are trading close or below book value. The next one is sector and geographical allocation. REITs are broadly split into the following categories based on their real estate portfolio. There is commercial, which is offices. There's retail, being shopping malls. Hospitality, which is retails or service residences. Industrial, being warehouses and factories. And a broad group of other allocation being things like healthcare and data centers. How will the sector or geographical allocation perform in the short or longer term? Each industry and geography has its own cycles. Try to take a long-term view and ensure that you are broadly diversified across geography and across industries to maintain a stable distribution. Next one is on the quality of assets. The key question here is whether the properties held by the REIT are attractive in the longer term. The properties held by the REIT are key because that's what you're investing in. A test that I like to use is to imagine whether, if I had sufficient money, I would want to own the property in its entirety. If the answer is yes, then it passes this test. Distribution yield. The key question here is whether the yield is attractive relative to other comparable investments. Compare the yield of the REIT against the yield of a 10-year Singapore savings bond. This is known as the yield spread. Look for as high as a yield spread as possible relative to its peers in the same geography and asset class. For its peers, you can use the same REITs they use to compare price over NAV. Now the average yield spread for REITs as an asset class is about 3.8%, but good REITs will consistently trade at a lower yield spread. Those from the CapitaLand and Mapletree are good examples of good REITs that consistently trade at a lower yield spread. Look also at the interest rate cycle and the sustainability of dividends. Whether it's a company accounts, investors' returns, only one thing is real: cash flow. Financing. The key question here is, will the REIT be able to refinance its debts when they come due? How will interest rate movements affect the REIT? Look at the gearing of the REIT. Of course, the lower the better. If the gearing is above 39%, that should set your alarm bells ringing and you should be extra cautious. Do also note that perpetuals do not show up on gearing, which is one of the key reasons why REITs love them. As an investor, make sure that you check if a REIT has perpetuals and add them to the gearing number. Otherwise, it could give you a deceptive picture of the REIT gearing level. Look also for well spaced out debt maturity with no big debt repayment in any year for the foreseeable future. Look also at the interest rate cycle. REITs are basically leveraged investments in real estate. So when interest rates are going up, REITs have to pay more on their loans, and this affects the distribution. So a low interest rate environment is great for REITs, and a rising interest rate environment is bad for REITs. The track record of the REIT. Does the REIT have a good track record with unit holders? Now there's no easy answer to this question, but there are a few points that I like to look at for this. Be wary if a REIT consistently does big equity offerings and usually at a big discount to market price. Look also for REITs that have a consistent track record of selling non-core assets and recycling the cash into high quality assets that increase DPU. This is known as asset recycling. Look also for unit holders who speak highly of the REIT and are highly loyal. To sum up, for most investors, owning a portfolio of blue chip REITs is likely to provide the best total returns with the least risk and volatility. The key then is to manage your emotions. Many investors are so afraid of missing out when they see REIT prices going up. And when the price is going down, they're always hoping to get it cheaper. To do your research, to determine if you like the properties, and to buy when you're happy with the price. If prices drop, buy more, as your yield on cost increases. If you have no more resources, then just sit tight and wait it out. Nobody can hope to buy at the bottom all the time, but the key is holding power. And similarly, don't think that you'll buy winners all the time. Ultimately, it's the law of averages, the good, the bad, and the ugly.